Stock trading time frames. Using different stock time frames involves analyzing the same stock price data over different periods of time, such as days, weeks, months, or years. This allows traders and investors to view the stock's price action in a different context and identify different trends and patterns. 1. Short-term time frame. Analyzing a stock over a short period, such as a few days or weeks, can provide insight into the stock's near-term price movements and volatility. This is often used by day traders. 2. Intermediate term time frame. Analyzing a stock over an intermediate period, such as a few months to a year, can provide a view of the stock's medium-term price movements and trend. 3. Long-term time frame. Analyzing a stock over a long period, such as several years, can provide insight into the stock's overall long-term performance, including its trend and long-term growth potential. Different traders and investors may focus on different time frames depending on their investment style and goals. It's also common to use multiple time frames to gain a more comprehensive understanding of a stock's price action. The most common time frames used in stock trading are intraday. This refers to trading within a single day, with the goal of profiting from short-term price movements. Intraday traders may use time frames ranging from seconds to minutes to hours. Daily. This refers to trading based on daily charts, which show the price movements of a stock over a period of one day. Daily charts are popular among swing traders, who hold positions for several days or weeks. Weekly. This refers to trading based on weekly charts, which show the price movements of a stock over a period of 1 week. Weekly charts are popular among position traders, who hold positions for several weeks or months. Monthly. This refers to trading based on monthly charts, which show the price movements of a stock over a period of 1 month. Monthly charts are popular among long-term investors, who hold positions for several months or years. Using multiple time frames in trading or analysis provides a more comprehensive view and can help to confirm trends, improve decision-making and reduce risk. A longer-term chart provides a bigger picture of market trends, while a shorter-term chart provides more detail and can help to identify potential entry and exit points. By combining multiple time frames, traders and analysts can get a more accurate and complete view of the market and make more informed decisions.